The most dangerous investor isn't the one who knows too little. It's the one who knows too much. Information feels like power, but in investing, it's usually poison. The more you consume, the more confused you become. The more you analyze, the worse your decisions get. The market rewards ignorance more than intelligence, but nobody wants to hear that. I've watched brilliant people destroy themselves with their own research. They read everything, analyze everything, predict everything, and end up with nothing. Meanwhile, the simplest investors, armed with basic principles and selective ignorance, quietly build fortunes. Knowledge and wisdom are different things. Knowledge is information. Wisdom is knowing which information to ignore. In investing, wisdom usually means ignoring almost everything. Let me tell you about two investors. Same age, same starting capital, same 20-year timeline. One became obsessed with information. The other became obsessed with discipline. The results will tell you everything you need to know about the relationship between knowledge and wealth.
Meet James, a software engineer turned financial obsessive. When James decided to take investing seriously at age 35, he approached it like an engineering problem. He would research every variable, analyze every data point, and optimize every decision. James subscribed to 12 financial publications, 4 research services, and 8 market newsletters. He followed 47 financial analysts on social media and bookmarked 238 investing websites.
Every morning, James spent 2 hours reading financial news before work. Every lunch break, he analyzed market movements and earnings reports. Every evening, he spent 4 hours researching stocks, reading analysis, and adjusting his portfolio strategy. James was consuming 8 hours of financial information daily. He felt incredibly informed. He could discuss earnings ratios, technical indicators, market sentiment, Federal Reserve policy, global economic trends, and sector rotation strategies with impressive fluency. James believed his information advantage would translate into superior returns. He was wrong. Meanwhile, across town lived Robert, a high school teacher who had never read a financial publication in his life. Robert's investment strategy could be written on an index card. Buy broad market index funds every month, regardless of market conditions, and never sell. Robert spent approximately 15 minutes per month managing his investments. He automated his contributions, never checked daily market movements, and couldn't tell you the current level of the S&P 500 within 200 points. While James was analyzing quarterly earnings reports, Robert was grading papers. While James was studying chart patterns, Robert was coaching his daughter's soccer team. While James was debating whether to rotate from growth to value stocks, Robert was reading novels. The irony was beautiful and predictable. Robert, the man who ignored financial information, consistently outperformed James, the man who consumed it obsessively. How could this happen? How could ignorance beat expertise? How could 15 minutes of monthly attention produce better results than 8 hours of daily research? The answer lies in understanding the difference between information and noise, between knowledge and wisdom, between complexity and effectiveness. James was drinking from a fire hose of financial information, but most of what he consumed was noise disguised as signal. Financial media exists to capture attention, not to improve investment results. It needs fresh content daily, even when nothing important has changed. This creates a perverse incentive structure where irrelevant information is amplified and presented as urgent news. Every market movement is analyzed. Every economic data point is dissected. Every analyst opinion is reported as if it contains actionable intelligence. James consumed all of this noise and mistook it for valuable information. He felt informed, but he was actually misinformed. The constant stream of financial content was training his brain to see patterns that didn't exist and to react to events that didn't matter. Robert, by contrast, was immune to this noise because he wasn't listening. He understood, instinctively or by accident, that most financial information is designed to make you feel like you need to do something, when the best investment strategy is usually to do nothing. The first year of their parallel investing journeys illustrated this dynamic perfectly. During a volatile market period, James received dozens of analyses explaining why the market was falling and what investors should do about it. Some analysts recommended selling everything and moving to cash. Others suggested buying the dip selectively. A few recommended shifting to defensive sectors. Several warned about impending recession, while others predicted rapid recovery. James consumed all of these contradictory opinions and felt paralyzed. How could he make the right decision when the experts disagreed so dramatically? He spent weeks researching different perspectives and eventually decided to reduce his stock allocation by 30%, moving the money to corporate bonds. The market recovered within 2 months, and James's defensive positioning cost him significant returns. He had been right to worry about volatility, but wrong about its duration and severity. Robert experienced the same market volatility, but never knew it was happening. He continued his automated monthly investments, buying more shares at lower prices during the decline. When the market recovered, his consistent purchasing had positioned him perfectly for the rebound. James had access to superior information, but produced inferior results because he acted on that information inappropriately. Robert had no information but produced superior results because he didn't let information interfere with his strategy. This pattern repeated throughout their 20-year investing journey. Every market crisis found James consuming vast amounts of analysis and Robert continuing his simple routine. Every economic uncertainty found James adjusting his strategy and Robert maintaining his discipline. James's information consumption created 3 specific problems that destroyed his investment returns. First, information overload created analysis paralysis. With so many opinions and data points to consider, James often couldn't decide what action to take. By the time he finished analyzing a situation, the opportunity had usually passed. Second, constant information consumption created overconfidence. James felt he understood market dynamics better than other investors because he read more and analyzed more. This false confidence led him to make complex trades that simple strategies would have avoided. Third, information addiction created emotional volatility. Every piece of bad news felt urgent. Every market decline seemed to demand immediate action. James's emotions were constantly manipulated by information designed to create anxiety and activity. Robert avoided all 3 problems by avoiding the information that caused them. His ignorance wasn't a disadvantage. It was a strategic asset that allowed him to maintain discipline when more informed investors were panicking. The mathematical results of their different approaches were stark and predictable. After 20 years, James had accumulated approximately $1.2 million despite spending over 15,000 hours researching investments. His annualized returns averaged about 6.8%, significantly below market performance due to poor timing and excessive trading. Robert had accumulated approximately $2.1 million while spending less than 60 total hours managing his investments. His annualized returns averaged about 9.7%, roughly matching market performance due to consistent investing and minimal interference. Robert's ignorant strategy had produced 75% more wealth while requiring 99% less effort. James's informed strategy had produced inferior results despite massive time investment and constant attention. But the financial numbers only tell part of the story. The psychological costs of James's approach were equally devastating. James spent 20 years in a state of constant financial anxiety. Every market movement felt personal. Every economic headline created stress. Every analyst downgrade or upgrade triggered emotional reactions. James's investment strategy had become a second full-time job that paid him poorly and caused him chronic stress. He had traded 20 years of peace of mind for subpar investment returns. Robert spent the same 20 years largely unconscious of market volatility. His investment strategy required no emotional energy and created no anxiety. His ignorance had protected his psychological well-being, while his discipline had built his wealth. The contrast illustrates a fundamental truth about information and decision-making that extends far beyond investing. More information doesn't automatically lead to better decisions. Often, it leads to worse decisions by creating confusion, paralysis, and false confidence. James had fallen victim to what psychologists call information bias, the tendency to seek information even when it cannot affect action. He collected vast amounts of financial data that couldn't improve his investment outcomes, but significantly worsened his investment experience. Robert had accidentally discovered the power of what Charlie Munger calls selective ignorance, the deliberate choice to ignore information that won't help you make better decisions. This principle applies across many domains. Doctors who order too many tests sometimes misdiagnose patients due to false positives. Managers who collect too much data sometimes make worse decisions due to analysis paralysis. Investors who consume too much financial media sometimes achieve worse results due to emotional interference. The optimal amount of information for good decision making is usually less than what people think they need and far less than what they have access to. James's story illustrates several specific ways that information consumption can destroy investment performance. First, financial media is designed to create urgency around non-urgent events. Most market movements are random noise that don't require investor action. But financial media must present every market movement as significant news requiring analysis and potentially action. This creates a psychological environment where normal market volatility feels like crisis requiring response. Investors who consume daily financial media develop shortened time horizons and increased anxiety about normal market behavior. James felt compelled to react to every significant market movement because his information consumption had trained him to see every movement as potentially significant. This led to frequent trading that reduced his returns through transaction costs and poor timing. Second, financial media amplifies cognitive biases rather than correcting them. The most compelling stories are often the most misleading. Dramatic predictions get more attention than boring accuracy. James was constantly exposed to confident predictions about market direction, economic trends, and individual stock performance. These predictions felt authoritative, but were usually wrong. However, the constant exposure to prediction making convinced James that predicting market movements was both possible and necessary for investment success. This bias toward prediction over preparation caused James to waste time and energy trying to time markets rather than simply participating in market growth consistently over time. Third, information consumption creates the illusion of control over uncontrollable outcomes. The more James learned about market dynamics, the more he felt he should be able to predict and profit from market movements. This illusion of control led James to make complex trades based on his analysis rather than simple investments based on long-term principles. He confused knowledge about markets with ability to predict markets. Robert, lacking this knowledge, never developed the illusion of control that destroyed James's results. His ignorance protected him from the overconfidence that information often creates. Fourth, constant information consumption creates emotional volatility that interferes with rational decision-making. James's daily exposure to market commentary created a psychological environment of constant crisis. Every piece of negative news felt urgent and personal. Every market decline seemed to require immediate defensive action. Every period of uncertainty felt like an emergency requiring portfolio changes. This emotional volatility caused James to make decisions based on fear and greed rather than logic and patience. He sold when he should have bought and bought when he should have held, all because information consumption had made him emotionally reactive to normal market behavior. Robert's information isolation protected him from this emotional manipulation. Without constant exposure to market commentary, he never developed the emotional reactivity that destroyed James's discipline. The broader lesson extends beyond investing to any domain where complex decisions must be made under uncertainty. More information often creates the illusion of reduced uncertainty while actually increasing anxiety about uncertain outcomes. James spent 20 years studying market behavior, but never reduced the fundamental uncertainty of market outcomes. Instead, he increased his anxiety about that uncertainty while convincing himself he could control it through analysis. Robert accepted market uncertainty as unchangeable and focused on what he could control: his savings rate, his investment discipline, and his emotional reaction to volatility. This acceptance of uncertainty created better outcomes than James's attempt to eliminate uncertainty through information gathering. The psychological appeal of information consumption in uncertain situations is powerful, but usually counterproductive. Information feels like preparation, but it's often procrastination. Research feels like action, but it's often avoidance of action. James spent thousands of hours researching investments when he could have been increasing his income, reducing his expenses, or developing other skills that would have improved his financial outcome more than investment analysis.
Robert used the time James spent reading financial media to focus on his teaching career, his family relationships, and his personal development. These activities improved his life quality, while his simple investment strategy built his wealth automatically.
The opportunity cost of information consumption is often invisible, but always significant. Time spent consuming information is time not spent on activities that might produce better outcomes with less stress. James's information obsession also created social and professional costs that compounded over 20 years. His constant focus on market movements made him anxious company. His need to analyze every financial development made simple conversations complicated. James became the person at dinner parties who turned casual conversations into investment seminars. His relationships suffered because his information consumption had made him incapable of engaging with topics that didn't relate to his financial obsessions. Robert remained interesting company because his mind wasn't cluttered with financial noise. He could engage fully with family, friends, and colleagues because he wasn't constantly distracted by market movements and investment analysis. The social costs of information obsession are often overlooked, but always significant. People who consume information compulsively often become less interesting and more anxious over time. James's story also reveals the economic incentives that encourage destructive information consumption. The financial media industry profits from attention, not from improving investment outcomes. Publications that helped investors achieve better results by encouraging them to ignore daily market movements would go out of business because they wouldn't generate enough content to maintain reader attention.
The most profitable financial content is that which creates emotional reactions and feelings of urgency, even when those emotions interfere with good investment decisions. James was consuming content designed to make him feel informed while actually making him make worse decisions.
This creates a tragic irony where the investors who try hardest to improve their results through information consumption often achieve the worst outcomes because they're consuming information designed to increase activity rather than improve outcomes. Robert's ignorance protected him from this manipulation because he wasn't participating in the economic system designed to extract money from investors through emotional manipulation disguised as educational content. The mathematical simplicity of Robert's superior results reveals another crucial truth. Effective investing requires discipline, not intelligence. The behaviors that create wealth are simple but difficult to maintain under psychological pressure. Robert's strategy, regular investing in broadly diversified index funds, could be understood and implemented by any literate adult. The challenge wasn't intellectual but emotional, maintaining discipline during periods of market volatility. James's complex analytical approach felt intellectually satisfying, but was emotionally destabilizing. The more he learned, the less confident he became in his ability to make good decisions. Knowledge had increased his anxiety rather than reducing it. This paradox applies broadly to decision-making under uncertainty. Simple rules followed consistently often produce better results than complex analysis updated constantly. Discipline matters more than intelligence when outcomes are fundamentally uncertain. The investment industry has strong incentives to convince people that successful investing requires complex analysis and sophisticated strategies. This isn't true, but it's profitable for the industry to maintain this illusion. Simple investing strategies don't generate fees for money managers, commissions for brokers, or subscriptions for financial publications. The industry profits from complexity and activity, even when simplicity and inactivity produce better results for investors. James had become trapped in this system, paying for information and services that made his results worse while believing they were making his results better. He was a customer of an industry that profited from his confusion and anxiety. Robert had accidentally avoided this system entirely by ignoring the industry's marketing messages and focusing on simple principles that worked regardless of market conditions. After 20 years, James finally recognized the futility of his approach when he calculated the time value of his information consumption. 15,000 hours spent on investment research that had produced inferior results represented an enormous opportunity cost. If James had spent those 15,000 hours developing his professional skills, he might have increased his income enough to overcome his investment underperformance. If he had spent that time on relationships, health, or personal development, he might have created value that couldn't be measured in dollars. Instead, James had sacrificed 20 years of life balance for investment results that were worse than what he could have achieved with 15 minutes of monthly attention. This realization forced James to confront the psychological motivations underlying his information consumption. He had used investment research as a form of anxiety management, believing that more information would make him feel more secure about uncertain outcomes. But information consumption had increased his anxiety rather than reducing it, creating a psychological addiction to research that interfered with both his investment results and his life satisfaction. James began to understand that his information obsession was a form of intellectual procrastination, allowing him to feel productive while avoiding the emotional discomfort of accepting uncertainty. Robert had achieved better results by accepting uncertainty as unchangeable and focusing on behaviors he could control consistently over time. His apparent ignorance was actually wisdom disguised as simplicity. The contrast between James and Robert illustrates the difference between knowing and understanding, between information and insight, between complexity and effectiveness. James knew vast amounts about market behavior, but didn't understand how to profit from that knowledge. Robert understood that consistent behavior over time would produce wealth regardless of his knowledge about market behavior. Knowledge without wisdom is often more dangerous than ignorance with discipline. Information without judgment frequently produces worse outcomes than intuition with consistency. The modern world provides unlimited access to information, but limited guidance about which information deserves attention. This creates an environment where intelligent people can easily consume themselves into confusion and anxiety. James's 20-year journey from engineering success to investment mediocrity illustrates how the tools that create success in one domain can create failure in another domain. Engineering rewards analysis and optimization. Investing often punishes both. The skills that made James excellent at software development made him terrible at investing, because investing success requires different psychological tools than professional success. Robert's teaching background accidentally provided better preparation for investment success, because teaching requires patience, consistency, and focus on long-term development rather than short-term results. The final irony of James and Robert's parallel journeys is that James learned more about markets, but Robert learned more about wealth building. James could explain market behavior but couldn't profit from it. Robert couldn't explain market behavior but had profited from it consistently. After 20 years, Robert was wealthier, calmer, and more satisfied with his financial strategy than James, despite knowing almost nothing about the investment vehicles that had created his wealth. James was poorer, more anxious, and less confident in his financial future, despite knowing enormous amounts about investment analysis and market behavior. This outcome reveals the difference between education and results, between sophisticated analysis and effective action, between impressive knowledge and practical wisdom. The market doesn't reward investors for what they know, it rewards them for what they do consistently over long periods of time. And what works consistently over long periods is usually simple enough to be boring and reliable enough to be ignored by people seeking excitement. James had confused activity with progress, analysis with insight, and complexity with sophistication. He had optimized for feeling smart rather than becoming wealthy. Robert had optimized for becoming wealthy rather than feeling smart, and had accidentally discovered that wealth building rewards character more than intelligence, discipline more than analysis, and consistency more than sophistication. The lesson for anyone beginning their investment journey is clear. Decide whether you want to feel informed or become wealthy. These goals are often mutually exclusive, because the information that makes you feel smart often interferes with the behavior that makes you rich. Information consumption can become a form of sophisticated procrastination that prevents the simple, boring behaviors that actually build wealth over time. The most dangerous lie in investing is that success requires complex analysis and sophisticated strategies. The truth is that success requires simple strategies implemented with uncommon discipline over uncommonly long periods of time. James spent 20 years learning this lesson the hard way. Robert learned it accidentally by ignoring the information that would have confused him. In a world of infinite information, selective ignorance becomes a superpower. In an age of constant analysis, disciplined simplicity becomes a competitive advantage. The choice is yours: 8 hours of daily research that leads to mediocre results, or 50 minutes of monthly discipline that leads to superior wealth. Most people will choose to feel informed rather than become wealthy. The few who choose wealth over information will find that ignorance properly applied compounds better than knowledge. The market has been proving this for decades, but most investors are too busy consuming information to notice.